Welcome back everyone. In this video, we will give a quick review of all the risk profiles of simple positions that we can trade on the financial markets or everything that assumes the use of a single asset at a time. As you know, the market can do three: go up, down, or stay within a certain price range for a certain period of time. These are the 6 most important and simple risk profiles that we need to know in the world of derivatives. The first 3 strategies above are all bullish strategies: long future, long call, and short put. If we look at the 3 strategies below, short future, long put, and short call, we see that all 3 benefit from a bearish market. The main advantage of the strategies built with the futures, long or short, is their simplicity. They are easy to manage. In fact, the loss and the gain are very simple to calculate. They are one-to-one linear. If the market goes up 500 points, we earn $500. If the market decreases 500 points, we lose $500. Simple. They are assets that allow significant profits, but because their linearity, they can also bring us significant losses on our portfolio. For this reason, you must always use stop loss and take profit when trading these assets. The internet is full of advice on where and how to position stop loss and take profit. The point is always that if you use large stops and profits, you can lose a lot of money and earn as much. If you use tight stops and profits, you are always caught by the market swings. And it happens more than often that you lose the great big trends because they kick you out. Options are non-linear tools. They are more complex to understand and to manage, and unfortunately complexity is scary, and the fear arises only when talking about derivatives. However, as you can see, the long call and the long put have the main advantage that they can never lead to large losses, as their cost to open the position is certain and determinable, and it is our maximum risk. This is nice compared to the leverage and huge profits that these contracts are able to generate. They are tools that already have an implied stop loss and allow us to remain in position even if the market is temporarily swinging, taking stop losses and throwing out of the market people who are trading linear assets like futures, ETFs, CFD. Statistically, however, over 90% of options expires without value. So, the option buyer risks a long series of small but continuous losses. The option buyer needs an important movement of the underlying price in the wanted direction. And this movement must happen within the option expiration date. Of course, the few times you can take profit from a long call or long put position, you are rewarded for all the small losses, and the earnings can be very high compared to the invested capital. Small losses, very frequent, rare but consistent huge boom profits. On the other side, short call and short put positions imply that the collected premium is a statistical advantage that will lead the seller, most of the times, to keep all or most of the premium collected. Exactly as your car insurance company does. They collect premiums and insure against accidents. And they profit. The problem, however, are accidents. When the company has to pay and the loss shatters many premiums. Options sellers, in fact, have the same risks of loss of a future position, but not the same profit expectancy, since they cannot earn more than the premium collected. The single use of these tools implies advantages and disadvantages. An all-season tool does not exist. If you want to earn a lot, you have to risk a lot, as in the case of futures, stocks or ETFs. If you want to earn continuously by cashing a little at a time, you can be an option seller. But you expose yourself to the risk of linear instruments if the market turns in the wrong direction. If you are afraid and want to risk very little, the best choice for you could be the purchase of options, but you will statistically lose many times and book huge profits when you are right. How to do so? We can create combinations between options and combinations between options and futures so that we can merge the many risk and performance characteristics of these instruments. We can trade combinations that can be simultaneously less risky and more profitable. We must learn how to master the accelerator when the road is straight and how to use the brake when the road begins to be tortuous and difficult. Let us always remember, the market never gives anything to anyone. Knowledge, a bit of luck, and the money management of your portfolio can, however, lead to excellent and lasting results. Thanks for watching. See you in the next video.